There is a warning Ray Dalio has been repeating for years, and according to his research, the United States may be moving closer to the phase of the debt cycle that has historically created some of the biggest shifts in wealth, markets, and purchasing power. Most people are focused on stock prices, political headlines, and day-to-day economic news. Very few are paying attention to the deeper forces operating beneath the surface. Yet, history suggests those deeper forces are often what determine who preserves wealth and who loses purchasing power during major economic transitions. If you have never heard of the long-term debt cycle, stay with me because what you are about to hear could completely change the way you think about savings, investing, inflation, and the future of the dollar. This video is based on publicly available research, historical examples, and Ray Dalio's documented framework for understanding debt cycles. Nothing here is personal financial advice. Every investment decision involves risk, and you should always do your own research or consult a qualified professional before making financial decisions. With that said, let's begin. Over the past several decades, the United States has built one of the most powerful economies in human history. Economic growth, technological innovation, and global demand for the dollar created an environment where borrowing became increasingly easy. Governments borrowed, corporations borrowed, households borrowed. For a long time, the system worked because incomes, productivity, and confidence continued rising. But according to Dalio, every debt cycle eventually reaches a point where debt grows faster than the income needed to support it. When that happens, difficult choices begin to emerge. Those choices rarely appear dramatic at first. Instead, they show up through small changes in interest rates, bond markets, government finances, and monetary policy. Most people ignore those signals until the effects become impossible to miss. To understand why this matters, consider how the U.S. government finances itself. The federal government spends trillions of dollars every year. Tax revenue covers a large portion of that spending, but not all of it. The difference is financed through borrowing. That borrowing occurs through the issuance of Treasury securities. Investors, pension funds, banks, insurance companies, and foreign governments purchase those securities because they have traditionally been viewed as among the safest assets in the world. For decades, demand for Treasury debt remained extremely strong. As long as buyers were willing to lend money at reasonable rates, the system functioned smoothly. However, some analysts have become increasingly focused on what happens if demand begins to weaken while borrowing needs continue rising. Imagine a household that consistently spends more than it earns. As long as lenders remain confident, financing the gap is relatively easy. But if lenders become less enthusiastic, the borrower may need to offer higher interest rates to attract new capital. Higher rates increase borrowing costs. Higher borrowing costs create additional financial pressure. Eventually, maintaining the same spending pattern becomes increasingly difficult. While national economies are far more complex than household budgets, the underlying principle helps illustrate why debt sustainability matters. This brings us to one of the most important concepts in Dalio's framework. He argues that major debt cycles often move through predictable stages. In the early stages, debt supports productive growth. Businesses expand, consumers spend, and economic activity increases. In later stages, debt accumulates faster than income. Asset prices rise. Borrowing becomes more dependent on confidence. Eventually, policymakers face difficult trade-offs. Raising interest rates may slow inflation but can also place pressure on heavily indebted sectors of the economy. Lowering rates may stimulate growth but can weaken confidence in the currency if done excessively. The challenge is that by the time these trade-offs become obvious, policymakers often have fewer attractive options available. Recent developments in government finance have attracted attention because they may represent early signs of those pressures. Treasury auctions remain functional, but market participants closely monitor demand, yields, and beer composition. When yields rise, governments must pay more to borrow. When borrowing costs rise, while deficits remain large, debt servicing expenses consume a greater share of public resources. This does not automatically create a crisis. However, it can increase the importance of monetary and fiscal decisions over time. Historically, periods of elevated debt have often been accompanied by policy responses designed to support economic stability. Sometimes those responses include lower interest rates. Sometimes they include increased government spending. Sometimes they involve monetary expansion. The exact combination differs from one era to another. What remains consistent is that policymakers attempt to manage the pressures created by high debt burdens while avoiding severe economic contraction. Dalio's research examines hundreds of years of financial history and identifies recurring patterns. One pattern involves the relationship between debt, currency values, and purchasing power. When governments face substantial debt obligations, there can be incentives to maintain financial conditions that make those obligations easier to manage. Inflation can play a role in that process because debts are generally fixed in nominal terms while prices and incomes may rise over time. For borrowers, moderate inflation can reduce the real burden of existing obligations. For savers holding large amounts of cash, inflation can reduce purchasing power if returns fail to keep pace with rising prices. This is one reason why investors pay close attention to monetary policy. Central banks face a difficult balancing act. They aim to support economic growth, maintain stable prices, and preserve confidence in the financial system. Achieving all three objectives simultaneously becomes more challenging when debt levels are elevated. Decisions regarding interest rates can influence borrowing costs, investment activity, currency values, and inflation expectations. As a result, market participants scrutinize every policy statement for clues about future direction. Many observers are also watching the relationship between politics and central bank independence. Throughout history, periods of financial stress have occasionally created pressure for easier monetary conditions. Governments naturally prefer lower borrowing costs. Investors, however, also value confidence in the long-term credibility of monetary institutions. When markets believe policy decisions are driven primarily by economic analysis, confidence tends to remain stronger. When investors perceive increasing political influence over monetary decisions, questions can emerge regarding future inflation and currency stability. Historical examples provide useful context. During the 1970s, the United States experienced a period of elevated inflation, rising commodity prices, and significant economic uncertainty. Gold prices increased dramatically. Energy markets experienced major disruptions. Bond investors faced challenges as inflation eroded the value of fixed payments. The decade demonstrated how changes in monetary conditions can affect different asset classes in very different ways. Another frequently cited example occurred after the global financial crisis. In response to severe economic stress, central banks implemented extraordinary measures designed to stabilize financial markets and support recovery. Interest rates fell to historically low levels. Asset purchases expanded central bank balance sheets. While those policies helped prevent deeper economic contraction, they also reinforced investor awareness regarding the long-term relationship between debt and monetary intervention. According to Dalio's framework, the key question is not whether a specific crisis will occur next month or next year. The key question is how investors should think about risk when debt levels are high and policy flexibility becomes more limited. History suggests that diversification becomes increasingly important during these periods. Assets that perform well during one economic environment may struggle in another. Concentration can create vulnerability. When conditions change unexpectedly, gold often enters these discussions because it has historically been viewed as a store of value, independent of any individual government's currency. Gold does not generate cash flow and can experience substantial volatility. However, during certain periods, characterized by inflation concerns or declining confidence in paper currencies, investors have frequently increased their allocation to precious metals. Central bank purchasing activity has also attracted attention in recent years, leading some analysts to interpret gold accumulation as a sign of long-term strategic positioning. Energy assets represent another area frequently discussed within inflation-oriented frameworks. Energy is a fundamental input for modern economies. When energy prices rise significantly, the effects can ripple throughout transportation, manufacturing, agriculture, and consumer spending. Companies involved in energy production may benefit from higher commodity prices, although they also face operational and geopolitical risks. Historical periods of inflation have often coincided with stronger performance from certain segments of the energy sector compared with the broader market. Fixed income investments present a more nuanced picture. Many investors view bonds as conservative assets, but bond performance depends heavily on duration and interest rate sensitivity. Long-duration bonds can experience substantial price declines when interest rates rise. Short-duration instruments generally have lower sensitivity to rate changes and may adapt more quickly as yields adjust. Inflation-protected securities were specifically designed to help address purchasing power concerns by linking principal values to inflation measures. Understanding these differences becomes increasingly important when inflation and interest rates are uncertain. International diversification also plays a role in Dalio's thinking. Many investors maintain substantial exposure to their home country. While this approach may feel comfortable, global opportunities exist across multiple regions and economic systems. Different countries face different demographic trends, fiscal conditions, resource advantages, and policy environments. Diversification across regions can reduce dependence on the performance of any single economy or currency. One of the most common mistakes investors make is assuming that what worked during the previous decade will automatically work during the next decade. Markets evolve, economic conditions change, leadership shifts, technological innovation creates new winners and losers. Debt cycles progress. The future rarely unfolds exactly like the past. Successful long-term investing often requires adapting to changing conditions rather than relying exclusively on familiar narratives. If Dalio's interpretation of the current environment proves correct, the coming years could be defined by greater volatility, more frequent policy interventions, and increased competition between inflation management and growth support. That does not necessarily imply disaster. Economic transitions can create both risks and opportunities. The challenge is recognizing that conditions may differ from those investors became accustomed to during previous periods. Consider your own financial situation for a moment. How much of your wealth depends on a single asset class, sector, country, or currency? How resilient would your portfolio be if inflation remained higher than expected? What happens if interest rates stay elevated longer than markets anticipate? What happens if global capital flows continue shifting in ways that challenge existing assumptions? These are not questions designed to create fear. They are questions designed to encourage preparation. The reality is that nobody knows exactly what will happen next. Forecasting the future with precision is impossible. Even the most respected investors in history have been wrong many times. What matters is understanding probabilities, recognizing risks, and building resilience. That is ultimately the central lesson of Dalio's work. The goal is not prediction. The goal is preparation. Today we see rising debt levels, persistent fiscal deficits, evolving monetary policy, geopolitical uncertainty, changing global alliances, and increasing discussions about the future role of the dollar in the international financial system. None of these developments alone guarantees a specific outcome. Together, however, they form a collection of signals that deserve attention. History repeatedly shows that major economic shifts appear obvious only after they happen. Before they occur, the evidence is scattered across bond markets, policy decisions, capital flows, and macroeconomic trends. Most people ignore those signals because daily life feels unchanged. Yet by the time changes become visible to everyone, opportunities for adjustment may already be smaller. Ray Dalio's research suggests that understanding the long-term debt cycle provides a framework for interpreting these developments. Whether you ultimately agree with his conclusions or not, the framework encourages a deeper examination of the forces shaping the global economy. It challenges the assumption that current conditions will continue indefinitely. It reminds us that debt, money, and confidence are deeply interconnected. As we move forward, investors will continue monitoring government borrowing, Treasury demand, inflation trends, central bank policy, commodity markets, and international capital flows. These indicators may provide important clues regarding the next phase of the economic cycle. The outcome remains uncertain. The stakes remain significant,